Hello, this is Randy Alsman from Donaldson Capital Management. I'm recording again the key messages from our June 4th Investment Policy Committee meeting. Our meeting today was primarily composed of discussing our economic and market outlooks prompted by the large reaction of the stock market to last Friday's jobs number. As you remember, last Friday the non-farm private payrolls were up about 89,000 and people expected about double that, a little bit less than double that, and the market dropped several hundred points as a result. We thought that was an overreaction, still think it was an overreaction, but we thought it was a good reason to stand back and write down on a whiteboard what we could think of as positives for the economies and negative for the global economy and things that we just didn't know. You could probably name a lot of the positives and negatives yourself, and the biggest influences, as usually is the case, are the big unknowns. And in our view, the three biggest unknowns were: how will the Europe situation end up being resolved? How will the U.S. debt and deficit problems end up being resolved? And what will be the outcomes of this fall's presidential and congressional elections? Those three uncertainties seem to be weighing the heaviest on investors' minds. And to kind of jump ahead to the end conclusion we reached today in our meeting, the bottom line is that we do believe that global economic growth is slowing. It's not going to grow as fast in 2012 as we might have thought a couple of months ago, but we do not foresee a global recession, nor actually do we see even a U.S. recession. We believe that Europe will almost certainly enter a recession if it has not already, and that has an impact. That's the primary cause of the global slowdown, but we don't see a recession in the cards right now anyway for the United States. Back to the jobs number, as much as that reaction captured the headlines, it's important to know several things about that report. Number one, that is not raw data. Those are not the totals that came back from the job surveys. Those numbers are adjusted. They're adjusted to try to reflect the impact of seasonality. That is, there are retail jobs that come on in preparation for holiday sales, and there are retail jobs that go away after the holiday sales season is over. There are construction jobs that come on stronger in better weather months, etc. And the folks who take this data and report it try to make adjustments for what should be expected and then compare the actual numbers against that, and then you get really a number that is a variance from an expected number. Well, several things about the last several years have been unusual, certainly not in keeping with longer-term trends. The big deep recession we had and the very warm weather we had coming into the beginning of this year in the mild winter. All of those things would tend to throw off longer-term trends and therefore would complicate seasonal adjustments. So we thought it was an overreaction when the number was an adjustment of several adjustments that were guesses based on estimates, based on historical trends. What we do believe, looking at the unadjusted numbers over time, is that there are jobs being created, but creating slowly. That is, possibly slowing down a little bit, although not nearly as dramatically as the adjusted numbers would have shown. And that we still sort of come out where we were before, that we're in a weak, uneven recovery. And I think this is what you heard us say last week, and nothing has come up in our discussions today and the data that we looked at that would change that. The slowdown in Europe and actually the tightening financial standards, tightening lending standards by European banks that are under attack by sovereign debt that is weak, that weakened financial support and the weakened demand is hurting emerging market economies. Think China, think Brazil, think others. And that has an indirect knock-on effect on the U.S. And the combination of those two things, the direct and indirect European impacts, are what cause us to take down our estimate of GDP growth for the U.S. and for the globe for the rest of 2012. However, the market reaction we thought was extreme, which is the nature of market reactions. In the words of Joe Zabertansky on the Investment Policy Committee here, he said this was a trade, not a trend, meaning it was a ploy, a play, a bet in the shorter term, most of it, and not large long-term investors making definitive judgments about longer-term prospects. Certainly some of that may have happened, but most of it was short-term reactions trying to capitalize on how others would respond to it. We took a look at our portfolios and the products, the companies that we own inside those portfolios to see what, if any, changes we might want to make right now. And again, remember, we take a longer-term view in building our portfolio strategy, not a shorter-term view. Our income builder portfolio, which is heavily based on bonds and preferred stocks and stable, high dividend, low growth companies, that portfolio is pretty good as it stands. We don't see any changes needed there. Capital builder is a higher growth, higher beta, more volatile portfolio. We have recently retooled it to take advantage of volatility, and you would expect it to move more up and down in markets that move up and down. We feel pretty good about it, although we're constantly fine-tuning it as well. And Cornerstone, where most of our clients are, is much more defensive by nature, and we believe that it's still located in a pretty good spot. If you take a look at the price-earnings ratios out there for defensive kinds of companies, the utilities, the staples, those stocks have gotten very expensive as people have gotten more worried over the last several weeks. So there are not a lot of bargains out there in the highly defensive stocks. Fortunately, we already owned a number of those. We saw them do quite well. Looking at the total market, the S&P 500 has a price-earnings ratio of about 12.4 right now, meaning for every dollar of earnings, you're going to pay $12.40 for a share of stock. The longer-term average is more like 17, so stocks are undervalued by historical standards. Yet, in the first quarter of this year, the earnings per share for those companies went up almost 6.5–7%, and that is somewhat in line with our view of mid to high single-digit earnings for the S&P 500 this year, with a slightly faster growth in the back half of the year than in the front half of the year. Again, we don't see any major need to change that, and we do believe that stocks are still relatively undervalued right now. And most analysts over the last 4 weeks have, if anything, increased their earnings outlooks for 2012. It's true that those analysts generally are more optimistic than the average bear. They tend to somewhat be late to the game whenever earnings start dropping, and we try to keep that in mind, and we discount some of their numbers to some extent. But when we looked at the fundamental financial data for each of our companies and not at the analyst forecasts, the financial data continues to be very strong, and the numbers and the backlog and the orders tend to be very strong. So we still feel very good about our companies. There's $2 trillion of cash on corporate balance sheets out there. They're much stronger than they were prior to the last recession. They have less debt than before. Many have called in old debt that was expensive and reissued new bonds. We've also seen a lot of municipalities, states, and cities reduce their debt and reduce their deficits. A lot of work has been done on that in the last 3 or 4 years, and that has made the debt that we own, those municipal bonds, much stronger, much safer than before. So there are many differences in the current economic environment versus 2008 that put us in a better position to deal with any kind of challenge from Europe or elsewhere. And that gave us confidence in sticking with our current outlook. So where are we? We are where we believe the year is going to come out. The world is going to muddle through. We do have some big unknowns, and a single catastrophic event in any of those could have a major impact. At this stage, however, we do believe that the powers that be in Europe and in China and in the U.S. will find a way to mitigate the potential catastrophic events of doing nothing. And we see that progress is slowly and grudgingly being made in Europe toward a more common view, and Germany is slowly being brought to the table. In the U.S., we believe the political process will do its little brinksmanship thing and still come to a good conclusion. And we see that the underlying economy and economic numbers, beyond just the jobs number and beyond just corporate earnings and balance sheets, we do see continued steady growth, muddling through, yes, but continued signs of increased strength. And that's a good thing. The thing also to remember is, again, the kinds of companies that are in our rising dividend portfolio, and we talked about this in the meeting today, are very strong, very global, very highly liquid companies. And by that I mean you will not be trapped in any company's stock. If there is a turn in the economic condition for the worse, we will be able to make trades and pivot the portfolio and make changes in companies, and you will not be in a situation where you find yourself with a stock you're unable to sell. These are very strong, very global companies that have been around for decades and that have been very financially strong and have continued to be strong through tough times as well as good. And right now what we see is an economy that's not terrible globally. It's not as strong as we'd like it to be. It's certainly not taking off into fast growth mode. There are troubles, obviously, but there always are. And right now it appears that we have appropriately positioned portfolios for a mid to single digit earnings growth for the year for our companies and a 2 to 2.5% U.S. GDP growth, slightly higher than that for global GDP growth, even in its slowing mode. So that was the outcome of our discussions today in the Investment Policy Committee. Obviously, we continue to monitor all of these factors, and we will keep you posted, and we will keep updating our strategy as is called for. Thank you all very much. Have a good day.